Disclaimer. A profound and unsettling event occurred on December 26, 2025, an event with a potential to send shockwaves through the very foundations of global finance. While the nation slept, recovering from holiday festivities, the Federal Reserve Bank of New York executed a silent emergency operation, injecting a staggering $17 billion in liquidity directly into the banking system. This was not a routine adjustment, not a scheduled open market operation, but a pre-dawn urgent intervention at 8:00 a.m. on a day bracketed by a holiday and a weekend. The imagery is stark, a financial fire alarm blaring in a silent, empty headquarters while the country remained unaware. This single transaction signifies a potential breach in the financial levees, and according to an exclusive investigative report published by Pulitzer Prize-winning journalist David K. Johnston on December 29th, this emergency action is intricately linked to a catastrophic multi-billion-dollar position unraveling in the silver market. The institution at the center is banking behemoth JPMorgan Chase, and its exposure, as detailed in the report, stands at a breathtaking $13.7 billion. The core thesis is both simple and terrifying. A systemic bank, through a series of disastrous bets, has become trapped in the silver market, and the Federal Reserve has begun administering emergency life support, raising the alarming possibility that the United States has quietly lost control over the supply chain of one of the planet's most critical industrial metals. To comprehend the gravity of that $17 billion injection, we must first examine the Federal Reserve's normal plumbing, the repo market. For years, the Fed's standing repo facility, a window where banks can borrow cash overnight by posting high-quality collateral, saw minimal usage. Throughout 2024 and well into 2025, this facility was largely dormant, a sign of a system awash with liquidity and stability. Then, a distinct and troubling pattern emerged in the final quarter of 2025. Beginning in late October, usage of this emergency lending window began an unmistakable climb. By Halloween, tens of billions were being drawn. By December, the outstanding balance had swollen to over $40 billion. This sets the stage for the December 26th anomaly, a single, gargantuan $17 billion draw by one institution at the earliest possible moment on the first business day after a major holiday. The timing is a screaming red flag, indicating a liquidity need so desperate it could not wait. Johnston's report crucially connects this specific distress not to broad market turmoil, but to a concentrated existential problem in the silver futures market. This narrative is further cemented by a monumental and largely overlooked policy shift by the Fed on December 10th, just 16 days prior to the bailout. On that date, the Federal Reserve removed the aggregate operational limit on its standing repo facility. In essence, they declared the emergency lending window uncapped. This is not a routine technical adjustment. It is a contingency measure historically deployed only in the face of severe impending financial stress, as seen in September 2019 and March 2020. The Fed, it appears, was not reacting to a crisis on December 26th. It was preparing for one it knew was coming, quietly positioning its financial fire trucks outside a specific burning building. The identity of the institution in the burning building brings us to JPMorgan Chase and its decade-long, deeply controversial relationship with the silver market. For years, JPMorgan was the undisputed king of the short side in silver futures, amassing a position reportedly as large as 200 million ounces, a massive bet that the price of silver would fall. Their dominance was so profound it crossed into illegality. In 2020, the bank paid over $920 million in fines for manipulative trading in precious metals markets, a fact established in federal court records, not conspiracy forums. However, the market narrative violently reversed in 2024 and 2025. Silver did not cooperate with the short thesis. Instead, it embarked on a historic rally, surging approximately 144% from January to December 2025, breaking through $50, then $60, and ultimately touching an interim high near $86 per ounce. Faced with this relentless upward march, JPMorgan did not merely cover its shorts. It executed a panicked, full-scale reversal. According to the most recent commitments of traders' data and delivery notices, JPMorgan has transformed from the market's largest short into its most colossal long, holding a reported 750 million ounces of long exposure in silver futures. This is a position greater than the entire annual mine production of the United States. They flipped from betting against silver to desperately trying to acquire physical metal, a strategy that has ensnared them in a trap of their own making. The problem is one of sheer physical scale and market mechanics. The global annual mine supply of silver is roughly 835 million ounces. JPMorgan's long position, at 750 million ounces, represents a claim on nearly an entire year's global production. As Johnston's analysis calculates, the mark-to-market exposure on this position is approximately $13.7 billion, a sum equivalent to the bank's entire quarterly profit. The bank is now bleeding from the carrying costs of this enormous position and faces a brutal mathematical reality. It cannot exit this position without moving the market catastrophically against itself, triggering further losses in a vicious feedback loop. Just as JPMorgan's trap was springing shut, a geopolitical masterstroke exponentially tightened the vice. On January 1st, 2026, China formally activated new export licensing restrictions on refined silver. The policy, announced through its Ministry of Commerce, does not constitute an outright ban, but something strategically more potent, a controlled bottleneck. It limits all refined silver exports to just 44 state-authorized companies, which collectively manage an estimated 121 million ounces of annual export volume. This controlled flow represents 60-70% of all globally traded refined silver. China is the world's largest net exporter of silver, having shipped over 4,000 tons in the first 11 months of 2025, while importing only a fraction of that. They possess the supply, but now they exclusively control its release to the global market. The immediate effect is visible in the Shanghai premium, the price Chinese buyers pay over the benchmark COMEX price, which has ballooned to $8.10 per ounce. This premium acts as a powerful magnet, pulling physical silver out of Western vaults and into Chinese storage, further straining an already tight physical market. The strategic implication was significant enough to draw public comment from figures like Elon Musk, who, on December 27th, noted the critical industrial importance of silver. China's move transcends commercial policy. It is a form of soft power leverage. By controlling the refined silver spigot, China gains immense influence over global industrial supply chains, and, as this crisis reveals, potentially over the stability of Western financial institutions caught in a physical metal squeeze. The United States, which just months earlier added silver to its official critical minerals list, now faces the grim reality of having outsourced a vital supply chain to a strategic competitor who has just demonstrated its willingness to weaponize that control. The true severity of this crisis is most starkly revealed not in Fed balance sheets or bank positions, but in the raw, screaming signals of the physical silver market itself. In October 2025, the silver futures market entered a state called backwardation. This is an abnormal condition where the price for immediate spot delivery is higher than the price for delivery in future months. In healthy commodity markets, the opposite, contango, is true, as future prices include storage and financing costs. Backwardation is a rare and powerful distress signal. It means the market values metal in hand today more than the promise of metal tomorrow, indicating acute physical scarcity and delivery anxiety. This backwardation emerged precisely as JPMorgan was aggressively standing for physical delivery on its futures contracts. Concurrently, the COMEX exchange is registered inventory, the silver actually vaulted and available to back these paper contracts, has plummeted to levels not seen since 2015, hovering around 80 million ounces. When measured against the billions of ounces in open paper claims, the leverage ratio becomes astronomical, somewhere between 100 to 1 and 250 to 1. This is a staggering disconnect. A vast, towering edifice of paper promises resting on a dangerously shallow foundation of real metal. It is the fundamental recipe for a market rupture, where the paper price and the physical price violently divorce, and the system fails to fulfill its most basic function, the delivery of the actual commodity upon demand. The fallout from this financial squeeze collides headlong with a stark national security vulnerability. The U.S. Geological Survey's formal addition of silver to the 2025 critical minerals list was a belated acknowledgement of reality. Silver is not merely for jewelry or investment. It is an irreplaceable component in every advanced technology underpinning modern defense and industry. Its unparalleled electrical conductivity is essential in missile guidance systems like the AIM-9X Sidewinder, in advanced naval radars like the AN/SPY-6, and throughout the Aegis combat system. The Department of Defense uses an estimated 35 million ounces of silver annually. Yet, despite this designation and the passage of major legislation like the One Big Beautiful Bill Act, which allocates billions for critical minerals, exactly $0 have been specifically earmarked for a national strategic stockpile of silver. The last such stockpile was sold off in 2002. The grotesque irony is that while the U.S. authorizes billions for silver-dependent weapon systems, it has no guaranteed supply of the metal required to build them. A defense industry analysis from mid-2025 noted with alarm that over $25 billion in authorized projects were silver-reliant without a secured supply chain. We are, in effect, planning a high-tech defense future with a critical material we do not control and have not prioritized, while our primary strategic rival now controls the majority of the world's refined export supply. We are left in early January 2026 with a highly volatile and dangerous convergence. JPMorgan is trapped in an unexitable 750 million ounce long position. China has constricted the global supply of physical metal. The physical market shows extreme stress through backwardation and draining inventories. And the Federal Reserve has already begun providing uncapped emergency liquidity to manage the fallout. The immediate trigger for the next phase may arrive on January 9th with the annual rebalancing of the Bloomberg Commodity Index. This technical event is forecast to force approximately $5 billion in institutional selling of silver futures over a 5-day period. Such concentrated selling could brutally pressure paper prices, threatening JPMorgan with another wave of massive margin calls precisely when its collateral is under stress. This sets up a potential paradox, a crashing paper price simultaneous with a skyrocketing physical premium, a clear sign of a breaking market. The resolution paths are narrow and fraught. A controlled crash requires improbable cooperation. A short squeeze could send prices parabolic as physical delivery fails. A government intervention would see regulators step in to forcibly settle positions, an action that would shatter market confidence. The $17 billion Christmas bailout was not a solution. It was a stopgap, a financial adrenaline shot to keep a patient alive. The underlying disease, a systemic bank caught in a physical commodity squeeze amid a geopolitical supply war, remains untreated. This is more than a story about silver prices. It is a stress test for financial market infrastructure, a lesson in supply chain fragility, and a warning that the most systemic risks can emerge from the most overlooked corners of the global economy. The alarm sounded on December 26th. The world is now waiting to see if it was heard in time.